Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. April was a very dramatic month for geopolitics and global markets. Donald Trump's tariffs created shockwaves, and while his stance has softened in the week since, there is plenty of potential for more disruption. Coupled with uncertainty about the outlook for the US economy, it means a nervous time for investors. My guest today is Dr. Alexis Crow, Chief Economist at PwC US, a global economist with a focus on geopolitics and long-term investing. She's in Australia at the moment and she joins us this morning. Alexis, welcome to Fear and Greed.
Thanks so much for having me, Sean.
So, how do you describe the last couple of months for investors?
Definitely a lot of fear and maybe not so much greed.
Oh, well put.
I would say that there's definitely a reordering of the global investing landscape and a recalibration of portfolios. The days of putting your money on the S&P, US, bond markets, US dollar assets, and letting it ride are over. And so diversification is really the name of the game. We've obviously seen how, one of the most prominent investors in the United States is sitting on record piles of cash. So cash is king. Diversification into, European assets, potentially also to China, new economy, also Southeast Asia. And this recalibration, I think, is very much underway, although it's not necessarily resulting in disorderly trading.
Okay, so that well-known investor, of course, is Warren Buffett and Berkshire Hathaway, who's got plenty of cash, hundreds of billions of dollars, I think. How do investors do that? I mean, you mentioned in an orderly way, which is great, but in Australia, we have these massive super funds and they literally have billions of dollars they need to invest. How do they think about, for example, the Magnificent Seven tech stocks? They've had such a run. Courageous not to be in them, courageous to be in them. How do you think about getting out of Wall Street?
I think it's not necessarily getting out of Wall Street. It's just the almost blind enthusiasm and heavy concentration. As you mentioned, only a handful of tech stocks. And as we know, certain announcements related to Moore's Law in the tech industry have even moved equity markets and some of those stocks dramatically shifting. So the way I think, Sean, people are looking at it is, particularly for these institutional investors, is to say, okay, I had 30% of my portfolio sitting in the US across asset classes. I'm not necessarily going to renew commitments or increase commitments, and I may reduce that by 10% over a certain horizon. And that's, I think, what we're starting to see is I'm not necessarily going to renew. The buy the dip is not my play. And over time, I'm going to start to shift and recalibrate my portfolio slightly.
You mentioned diversification as well in your first comments there. So whereabouts, cash obviously in equities and fixed income, bonds, corporates. What about those alternatives? How do you play the alternatives market at the moment?
It's interesting too, because again, going back to when the 60-40 portfolio allocation was created back in 1966, nobody was thinking about alternatives. Alternatives didn't really exist. And I think now when we speak to some CIOs, it's okay, I've got to be maybe 40, 20, and then ever increasing, I need at least 20% of my portfolio in alts. So I think the real estate and infrastructure landscape, so interesting here, sitting in the Asia Pacific region. You have some of the most, phenomenal fund performance in the infrastructure asset class sitting here. And that's something obviously the super funds know well. What's interesting also there is you've got other groups. I'm thinking of one French entity, and then you've got, several others that are starting to offer more retail investors access to infrastructure investments, which is fantastic, again, for those holding, a superannuation as well. In the real estate landscape too, I think what we've seen is there's something to note is, we've seen, again, a democratization of the asset class. So, we've seen that classically through REITs, but more and more, some of the largest asset managers in real estate starting to open their own wealth management portfolio boutiques to be able to draw in more retail investors and family office investors. But there's definitely, when we think about real estate, we think about private equity, something also to mention on the asset price landscape, particularly in the US, where asset prices remain very, very high. We've not really seen any meaningful correction. You saw mark-to-market losses, for example, in Germany, already in the property market. That bottom has been hit. But in the United States, we haven't necessarily seen a dramatic repricing of some real assets. And so that's something that I think has some of the most sophisticated investors holding pause and steady.
Private credit, we hear so much about that at the moment. How do you think about private credit?
I think it's a risk. I think it's a risk that is not necessarily being captured very well by certain regulators. The private credit market in the United States has been growing at 20% per annum. It's also been growing 20% per annum for the last 5 years in Europe. Only a slender part of the Asia Pacific total credit landscape, only 0.3% according to HKMA. But in the United States, if you think about that run up, it actually happened when we were in a very low rate environment. So as you go on with later vintages, there is a potential that you've seen a deterioration of underwriting quality, covenant light or cov light. And also, Sean, what I would say here is there's been an overwhelming supply created to meet the demand. And again, increasing retail participation in the space. So I think this trend of retail participation combined with where we are in the interest rate environment is a potential recipe for disaster.
Okay, Alexis, we'll be back in a moment. My guest this morning is Dr. Alexis Crow, Chief Economist at PwC US. What about this region? What's interesting? So as a global investor, what would they be interested in Australia, New Zealand, near Asia, those sorts of economies?
I just wanted to speak to the Asia Pacific region as a whole, so to include Australia. And it's interesting. It's the IMF put out their spring World Economic Outlook in April, and it downgraded the United States, and the rest of the world kind of moves on, right? And so I do believe that the largest economy in this part of the world, China, is exceptionally well positioned to be able to navigate any kind of uncertainty surrounding trade tensions from the United States. And therefore, I don't necessarily see any massive softer demand outlook for China, which of course would impact Australia. We saw record imports of oil in China leading up to the Liberation Day trade announcement. And so clearly the government is focused on continuing to use manufacturing to stimulate the economy, as well as driving consumption. And so we've seen concerted efforts by central bankers and finance ministers from ASEAN to promote inter-ASEAN trade, because ASEAN, of course, trades more with the rest of the world than it does within itself. Mm-hmm. And so some of these commitments, I think, will just have a positive knock-on effect for Australia. Another theme here is not just geographical, it's also to do with the energy landscape. And thinking about Australia's natural resource wealth is going to be very, very important, because we're living in a world of energy addition, not necessarily energy transition. So as we need more energy sources, I think Australia is in pole position to be able to cater to this demand.
Okay, and you're talking about renewables in that instance?
I think renewables, nat gas, and rare earths.
Okay. Looking forward, what are the big risks? I mean, how much of a risk is the Trump administration? I think those outside the US see it very differently to those inside the US. I'm just interested from your take, Alexis, because you work out of New York. How much of it is Trump a risk?
Great question. So I would say that you've got two schools of thought. One is that we've had peak Trump, and that some of the policy shifts that we've witnessed, we've topped out and we've leveled out, and things will start to calm down. And then you've got team structural, which is that some of the policy shifts that have happened on the domestic institutions have given investors pause about the trajectory of the US economy, and that these are potentially longer term structural shifts that are happening that undermine the attraction and the lure of holding US assets over time. So I've spoken to investors from different parts of the world who are either in one camp or the other. I don't think there are very many in between. And so the risks that I would posit go far beyond the trade policy, and they go more into the rigor of institutional change that's happened on the domestic landscape and the potential knock-on effects for long-term growth, and of course the ability to push up the deficit, which is what we've seen with the credit downgrade happening last Friday. And so those would be my longer term concerns. That's on the investability of the United States. I would also say that we're witnessing wider shifts happening in the geopolitical landscape when it comes to alliances. And potentially this, America walking away from the globalization that it largely created and supported has potential ramifications, again, for its position in alliances, not only, with Europe, but of course, looking to this part of the world.
What about the change in the rules of governance? So I'm talking Trump versus Jay Powell from the Fed. I'm talking about the criticism of the judiciary system. We haven't really seen Trump v. the Supreme Court yet, but obviously that's the fear that we get to that point. Is that a real worry, or is that just the manner of the man in a sense? And when it really comes down to it, he's going to follow the Constitution and the law and do what's right.
As one former central bank governor wisely pointed out, it's not necessarily the independence of the central bank that is the concern. It's how markets perceive the independence of the central bank.
Yeah.
So therefore, I would say that where markets are when Jay Powell stands down in May 2026 is going to be an interesting one. So is the US economy performing well, and therefore would markets potentially shrug off any kind of loss of independence of the Fed? That's a question mark. My sense is that markets are being too complacent and that we are in a potential environment of stagflation in the United States. If we think about the outlook for inflation, many are hopeful in that first team, transitory. Many are hopeful that a potential 10% universal tariff would result in a one-off knock-on impact on pricing. Nevertheless, if we think about the exposure of the US housing market to lumber from Canada, the impact of steel and aluminum tariffs, which are sticking on the housing market, which is already in a crisis of affordability in the United States, and we recognize the fact that 1/3 of CPI in the US is covered by shelter costs. I do think we're in for a stickier inflationary environment, and amidst the uncertainty, slower growth. So to come back to your question, I don't necessarily think that investors would view a loss of independence at the Fed with particularly sanguine eyes. On the domestic political front, I do think that I'm continuously speaking with investors who are concerned about the loss of rule of law.
Yeah, it's a good place to leave it. Alexis, thank you very much for talking to Fear and Greed.
Thank you.
That was Dr. Alexis Crow, Chief Economist at PwC US. This is the Fear and Greed Business Interview. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.